Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, who likes his nickname, Gino Barbaro. Gino, how's it going?
What is it, Yaki Boom Boom Stenziano? Is that good enough? That's a good nickname for you?
Keep working on it. We'll hit it next time.
Yaki Boom Boom Stenziano. I'm doing good,
Maybe.
bro. How you doing?
I'm doing good. So you did an event this weekend, huh?
I think you did one too, right?
Oh, yeah, I was there. It was a good time.
175 people, 175, I think, satisfied, electrified, motivated, inspired, educated. It was great. It was one of the, I guess, highlights of my career. It was a lot of fun getting these people together. And I'm going to do a live call tomorrow on Facebook just to talk about it. It's like we bought our first property again, and we're on the shot. It's like everybody else. They always ask, well, what size should you go? Well, whatever size you feel comfortable. And Jake, what did I say in the beginning? I'd be happy if we got 175. I should have said I'd be happy if we got 275. So a lot of lessons learned on that, Jake. But it was awesome. I really, really enjoyed it.
I think it started off kind of like a Guns N' Roses concert, but then the feedback was it turned into a family reunion. So I'll take both, right?
Yes, I agree.
Okay. Hey, before we get started, I want to give a quick shout out to our sponsor, CrowdStreet, who knows you don't have to know a guy, unless it's Gino, to find a quality commercial real estate investment opportunity. Learn more at crowdstreet.com/wheelbarrow. And for visiting their site, they're going to give you a free gift. And Gino, we're creeping. We're going to be on there next year. It's coming, Big Daddy.
I know, waiting.
It's coming. Today's guest is Mark Kenney. Mark is a seasoned real estate investor, entrepreneur, and the founder of Think Multifamily. He started his real estate career over 20 years ago and has extensive experience in property valuation, acquisition, and operation. Mark has invested in over 1,200 units and has a top-notch reputation among the multifamily investment community. So without further ado, Mark, welcome to the show.
Thanks, guys, for having me. I appreciate it.
It is our pleasure. I'm really pumped to have a real estate guy on the show today. Why don't you tell us about your background and how you got started in multifamily?
Yeah, background briefly was I was a CPA for a couple of years. Decided I didn't like that too much, and then I did IT consulting, which I know you guys love IT. It sounds like
we love IT.
I said I'm an ex-IT guy, but I actually started buying a small multifamily right out of college. Actually had my first offer accepted when I was 21 years old, in college still, and my dad talked me out of it. So I used to take him on property tours with me. I don't think there's a property on the planet that's a good enough deal for him. So what I ended up doing is I found a property and I'm liking, didn't tell my dad about it, bought it, and then told him I bought it. So, I was listening to the wrong guy. He's a great guy, but he's 80 years old and never bought a property in his entire life. So
that's the daddy end around. That's
right. And, now we actually have about 2,000 units now, I think, on the
awesome
file.
I took it off the website. Sorry.
Yeah, no, that's totally good. And so it's kind of a lesson learned. I was listening to the wrong person. I didn't really have any mentor at the time teaching me anything. So I decided to go for it. I loved real estate at the time and wanted to make it work.
So why did Dad say no? What was the I guess you didn't dispel his myths good enough. So you weren't a salesman at the time. So why was he saying no to you?
I think my dad, it doesn't matter what it is, cars, houses, clothes, it's never a good enough deal, no matter what it is. And at the time, I'm young, 21 years old, definitely looking up to my dad for advice. And he just said, well, I think you're going to have a problem because it's an older building, essentially. And that scared me enough to not move forward. And then the property he bought was one that needed a full rehab, pretty much down to the studs. So
that one didn't pass the smell test either, I'm guessing.
It would not. Well, I didn't invite him on the tour. I bought it first and told him.
So question is, what did your dad want you to do?
I don't really know. I think he wanted me not to move forward on that, but we looked at probably 30 properties with him in our small town, and there were no deals that actually seemed good enough for him. I think he thinks if you can't get a killer deal, then don't ever move forward. And the fact is, a good deal is a good deal. It doesn't always have to be a killer deal. I love the killer deals, so they're hard to come by, but not every deal has to be killer in order to make it work financially.
So when was the inflection point for your father? When was he bought in and he said, wow, my son is really crushing it?
Probably not until we started going larger. So I bought that first one when I guess I was 22, and it wasn't until about 4 years ago that I started buying large multifamily. We bought smaller ones, and we still worked full-time jobs at the time. So about 4 years ago, we started buying larger properties, and I think at that point in time, when I'm telling them, hey, we're looking at a property that's 200 units or 300 units, he was kind of like, whoa, going from a 4-unit to a 200 plus unit, where it might be. And then when he saw that I was able to quit my IT job, which I was doing really well at, I think that's kind of where he was like, this is legit.
So what'd you do out of college?
CPA for 2 years, and ended up being an IT consultant, management consultant for a long time as well, for large organizations, traveling around everywhere.
So I think if you'd been a CPA, then an IT, and then a lawyer, I think you'd have the trifecta there, right?
Well, funny enough, I almost went back to be a lawyer. Funny enough, until I saw what they paid out of school, and I'm like, I'm not doing that.
Well, it's amazing because now you have to hire all 3 of those guys, and actually you are going to be one of those 3. It's amazing, isn't it? How life works out. It's just unbelievable how it is.
It definitely is. If
wow.
someone told me I'd be doing what I'm doing, I wouldn't have believed it right now.
I can echo that exact sentiment. What gave you that paradigm shift to go big? What was that push that you needed to say, listen, 4 units is great, but I can get bigger?
Mine was probably more of a personal issue. I had a IT company. I had projects with like Marathon Oil, T-Mobile, Lockheed Martin, good companies, right? Sleeping probably 3 hours a night and working 90 plus hours a week. And spent no time with my wife. I had 2 kids at the time as well, so it caused a lot of personal issues. And so about 4 years ago, I had to make a decision to say I'm either going to keep doing what I'm doing and likely not have a very good family situation, or make a change. And I decided to make the change and pretty much quit IT almost cold turkey. And
so when was that? When do you remember that specific day or that specific time when you said, that's it, I'm done?
It was about 4 years ago in August, probably. It was a rude awakening, but it was something that needed to happen. And sometimes when you're going through it, you don't realize where it's going to end up, but it has ended up well.
And what market were you guys living in or investing in at the time?
So I'm in Dallas. So we've bought a lot in Dallas. We're really not buying here right now, although I love the market. We haven't bought here for about 13 months. We're buying in Atlanta, Memphis, and looking a lot right now in Southeast U.S. for the most part.
So can you walk us through that first big deal you did? Tell me what you liked about it. Tell me, what the value adds were. Just go through that deal and how did it pop up on your radar?
Sure. It was a total of 64 unit deal. So not super big, but big enough for the time. It seemed like it was. It actually was 232 units right next door. One was listed with a broker, so it was a listed property. And then the other one next door was the same seller. So we talked to the broker about the one next door as well. The value add on that, it was a mid-'80s construction, so a little bit nicer than some of the other properties we bought. On a right between 2 expressways, probably 200,000-300,000 cars a day go by there. Good construction, built as condos, so it was a little bit nicer construction. Mm-hmm. But interiors really haven't been updated. So exterior was nice, interiors really weren't updated, and we knew they were below market on the rent. And it was self-managed as well, which is another. If we can find those, I love them. If we can find them.
So Mark, you were working at the time in IT. So did you quit your job right after you got the property? How long was that transition before you said goodbye to the grind?
Probably within 6 months.
Wow, that's great. You escalated really quick. That's awesome.
I did, yeah.
So talk about that deal. I mean, how are you able to leave your job? I mean, what did you end up doing to the income? What did you end up doing to the expenses?
Well, for the income, we drove income up for sure. I think as far as a lesson learned on that deal, we actually should have raised a little bit more capital. We raised additional working capital, but looking back at it, I think if we would have raised a little bit more, we could have even improved it further and drove the NOI up even further than we did already. Expenses, my big thing was too, even though I was done with IT, So just to preface it, I had an IT company that had a couple ongoing contracts that I didn't participate in, but I was able to generate money off that too. So I personally wouldn't be able to live off 64 units on my own just by doing that. But with the other income from previous products I sold that was ongoing for like 2 more years, that helped me kind of make that decision. And
so Mark, did you have any mentors when you were doing this, or you just said, hey, I'm smart enough where I can do this on my own and just go for it?
I did. We did have a mentor. We were part of a group at the time, and then I had a mentor originally, first out of college, that was really more of a broker that really pushed us and got me super excited about real estate. He was a commercial guy that pretty much brought everything to our small hometown. He put the Walmart in there. He put all these big names there. So he inspired me. But we had a mentor that we were working with when we bought our first 64 unit as well.
I was wondering if you could just go over what your investment strategy is, and after that, just tell me how it's changed from when you first started.
Sure. Investment strategy, we've always looked for properties that can at least cash flow something. Doesn't have to be a lot. But then we also were buying properties with zero cash flow, down the stud, 100% vacant type buildings, some smaller ones and some larger ones that had a significant amount of value add. And while I think those deals are good and can do well from a returns perspective, there are also some headaches that go along with that. And it will typically take a little more time, a little more money than you anticipate. So my strategy has kind of shifted a little bit to look at a little bit higher quality assets. I'm personally focused a little less on appreciation because at the end of the day, I think we're kind of in a crazy market in a lot of areas, and we're focusing more on cash flow areas of the country and less of appreciation because nobody knows what cap rate is going to be, a month from now, let alone 5 years. So you need the cash flow, in my opinion.
So you talked about Memphis, you talked about Atlanta. You're investing there for cash flow. Is that the idea right now? Yes,
Atlanta I think is definitely higher appreciation than Memphis for sure. Memphis for sure cash flow. Atlanta's combination. We have the cash flow, but I think the appreciation, they're probably, just my personal opinion, a couple years behind Dallas. They might never catch up to Dallas, but there's still an okay amount of appreciation there as well. And that's where we're looking for properties that can get that cash flow right out of the gate.
So what class are you looking for there?
We've been buying Bs and Cs, more Cs and Bs, and I want to go to more Bs than Cs. If we can. Not that there's anything wrong with it. I just think that we're at a stage now where we want to get a little bit higher quality assets, but you run the risk, returns can be a little lower. So you're dealing with investors that have expectations of previous properties, and now you have new properties you're buying that maybe the returns are slightly lower.
So that last deal you bought in Dallas, what was the cap rate? And what was, because it's funny, we're just closing a deal next month, but we haven't bought a deal about that length of time in our market because cap rates are really compressed. What was that last deal in Dallas that you bought? What were the cap rates and what was the grade about that deal?
It was about an 8 cap, I guess, somewhere around there. And now cap rates in that same area are 6.5 for the same property.
That's actually not bad. I mean, I've seen cap rates in Dallas down to 5 for
there properties. For this is probably a B minus, C plus, B minus. Their cap rates right now, I looked at a Class C property, 1972 for a 5.1 cap.
Mm-hmm.
So it depends on the area. For the area we're at over there, probably right now for a B, it's a 5 to 6 cap, generally speaking.
Not getting you too excited, is it?
And not getting excited at all. I'm actually getting quite frustrated. That's why we started looking outside of Dallas. And it's okay. People are still buying. But if I want to spend the energy, I want to look at places that are a little bit higher returns.
So now that you're going out of market, how do you qualify property management companies? One of the big things that we had on our event over the weekend was the real problem that people are having with managing their properties. How do you qualify a property management company? How do you find one, and how do you keep them accountable?
Yeah, so finding two ways. One, I would say, is talk to brokers in the local market. That's one way. But I think a better way is to talk to lenders. So through lender relationships, find out, they have more invested than anybody else in the deal. Typically a lender does. So talking to them and finding out which property management companies they like, that holds a lot of weight with me. Qualifying them, kind of going through a list of questions as far as, asking for references, list of questions as far as what number of units they manage in the area, class, prior performances, things like that. Keeping them accountable. We've had some issues with property management companies. I would say, that's the hardest part of this once you close, the product, the price, everything else.
Can you elaborate on some of those issues? Give some folks some real world examples.
Yeah. So we've had issues where, actually had property in Dallas where they were telling us, we used to get a daily report from them, which is great. And they would say, all these units are pre-leased. So after, 3, 4, 5 days go by, we see number of units pre-leased, and try to find out, well, when are they people moving in? And one, they had 7 pre-leased on a 64 unit. They kind of drove it down for a bit there. And they had 4 people moving in like 6 weeks out, which is obviously not, in my mind, a good idea. And when I asked her, let's define what you believe pre-leased is. Do you actually have an application and do you have a deposit? Oh, no, we have no deposit. So big problem there. We had other issues where, some pretty significant issues where a guy, I think, is potentially in cahoots with a vendor, paying for things not getting done. So I think putting processes in place, end of the day, people say, well, how can that happen? Well, if anybody wants...
It happens very easily.
Yeah. Someone can be deceitful. They get away with it for a while. I think, yes.
Oh, no, I was just going to touch on 2 of the things there. So one quick takeaway, we do move-in fees actually on our property. So we don't do security deposits, the one-time $400 or $500 move-in fee. And so if it's going to be pre-leased, you better have that money hard or that apartment's going to go to someone else, because we also use that as a hold fee, okay?
Yes.
So just for the folks out there, this is how some of these systems can come into place to help you out. Also, on our software, we have direct access to our property management software. So right on, we can go right from our iPhones, click the app, pull it up, and it says, when is the move-in date? So if they're showing pre-leased, we know when that move-in date is. So folks, this is how you leverage your software and your systems to hold your folks more accountable. I just wanted to touch on a few of those. I think it's super important.
That's totally great, because I would say, unfortunately, until it's earned, don't trust your property management company. It's unfortunate. Yep. I think doing things, and what we're starting to do now is look at things where we're doing kind of an audit, where we'll pull something off the general ledger and backtrack it back to the invoice, and then contact the vendor to say, hey, what's the last invoice you issued to us? We don't tell them what the invoice number is. We don't tell them the amount, and find out, hey, does it match? That would probably be more apt for contracting services, less for some other things, because there's some scams going on out there where people are actually doing this and they're getting away with it.
There's 2 things I talk about is the application fees. They just seem like they tend to disappear. When you have 700 units and you got 10 or 15 application fees disappearing, it's a ton of money. The second thing I would say is don't ever take cash. At the live event, I was surprised at how many people take cash. And Jake always likes to hear me to say, cash is sticky. I was in a cash business forever, and that was the bane of my existence. I hated to deal with cash because it was not accountable. And something simple like that, we just don't. And we've taken over a lot of properties that had cash, and it's really easy to get tenants to either auto pay, ACH, credit card, check, money order, let's say, whatever it is, but don't take cash.
Yeah, absolutely. We don't either. That's absolutely for sure.
Big signs. Cash not accepted.
Exactly. And I think, you mentioned too, doing improv visits to the property. Sometimes people are like, well, why didn't you let me know you're coming? Well, I don't want you to know I'm coming. I want to come and check out the property, And you learn a lot by doing that, and talk to the people that are running the properties on a day-to-day basis and see what they're up to.
We don't want you just cleaning because we're coming, right? We want to clean and presentable every day.
Exactly right.
So, Mark, I am the property manager who's been stiffing you, who's been doing a terrible job. What's your next step?
Get you out. I'm actually in the process. I just got legally engage an attorney. But before that, you better make sure your property management agreement, don't just assume everything in there is hunky-dory. Have an attorney review it. Make sure you have an out within 30 days for no cause whatsoever. I don't like you. I'm sorry, you're out. Don't do it. Don't sign anything other than having it out within 30 days. And then take the legal action. Don't give them the grace period that they think, give me another chance, give me this or that. It's short-lived. They'll do okay again for a little while, then they'll go back to their old ways, unfortunately.
Spoken from a veteran in the business here, right, Gino?
I see some gray hairs there. That's why I was asking that question, because I know
Some lessons learned for sure, dude. Some hard lessons learned.
Yeah, well, that's you know what? Whatever doesn't kill you makes you stronger. We had a 21-year-old at our event, bought his first 21-year property this year, and he signed a 6-month agreement with his property management company, and he's not happy with them. So this is for Abraham out there. You hear that bit of advice, and I told you the same thing. The property management company might want to get rid of you too. So maybe that's the thing, saying, hey, listen, if you don't like me, you have 30 days to get rid of me, and vice versa. I have 30 days to get rid of you. Because if you're stuck there for 6 months, and like you said, you have no recourse to get rid of them, all of a sudden their performance, they don't really care because they know they're on the hook to get lost. So that's a great point. Yeah, you know, I love that point. Any other horror stories with management companies? Because we like to share the.
Gino, we only got 45 minutes.
One more story, bro, because this is really important. This is what people want to hear, because they think that we're sitting here rolling in the dough and it's cash flow and passive income, and it can be to a certain degree, correct? But there's a lot of stuff that goes into it.
Yeah, we have, you know, a guy that didn't record, wasn't recording bad debt. You know, why, I have no idea. And then lo and behold, in 1 month, all this bad debt shows up, in a significant, like several $100,000, right? So yeah, I don't know, man. I think that you need to make sure you're in the details, and you need to make sure you have an independent CPA looking at the books. Now, of course, they're going to only look typically at what's been recorded, but I would say take those steps to cross-check what you're seeing in the books, and then be careful about accrual-based counting. You know, I have a CPA background, but be careful about accrual-based counting. People play games with that.
Mm-hmm. Hey, Mark, I give you a lot of credit. I'd have no hair with that kind of thing. So at least you got some whites left, you know.
Right.
Let me ask you a question. I'm a beginning investor. You know, you're up to 2,000 units. You've scaled up with a lot of bumps and bruises. What would you say to the first-time investor? How should I get started?
First question I think you have to ask yourself is whether you're willing or wanting to partner with somebody or not. Just defining your criteria. Because if you're not willing to partner with someone, you're going to be limited to your own net worth and your own post liquidity for the loan, right? Mm-hmm. If you say I'm going to partner, then it opens you up. You're endless what you can do. But I would say get hooked up with like guys, you know, on these guys, right? Get hooked up with people that actually know what they're doing and been through it before. People say, oh, well, I have to pay a mentor and it's this much money, and it's not a cost, it's an investment, and you know you're going to get that back, you know, 50 times over if you actually take the advice and do it. We do education too, right? And it's like, hey, you have these discussions. Well, I got burned by a guy before. Yeah, and that's unfortunate. It happens, right? It's a small world. Check around. Do your homework ahead of time. Talk to people that have left people's group and find out why they left. But getting hooked up with someone that's done it before, it won't cost you. Don't be cheap on it. Get the best, and you'll get your money's worth.
So did you start syndication right off the bat when you got out of college from your deals, or did you start with your own capital?
My brother and I have an identical twin brother. So we started together, and my sister got into some deals. We did some flips for her and things like that. But then after the last 4 years, when we started doing more of the syndication.
Is your brother part of your company?
He's not. He joined together when we first did properties, and when he got married, his wife said, I don't want anything to do with real estate, and that was it.
Wow. So his wife and your father go hand in hand. Right. She must love your dad, huh?
Yeah, probably so. That's right.
Wow. So what happened to your brother? Did he transition to another occupation or career? Or
he's still in IT.
Oh, he's in IT. Okay.
He started as a as well, so we kind of follow each other around.
So you weren't the salesman. I mean, you got to be the salesman. You got to bring him in. You got to rope him in and say, hey, listen, we're going to go to 2,000 units. And he's going to say, yeah, sure. And now look at you. You're 2,000 units, right?
Yeah, that's right.
Wow.
Sometimes it's harder with people you're closest to.
You're preaching to the choir. You feel the energy, Jake, right? Wow. So, I mean, let me ask you, what else do you really like about real estate? What really drives you to do this every day? Because you have to have a passion for it, right?
You do, and I think that's a key point. Don't just say I'm going to quit my job and become a full-time real estate guy, because although I love it, there are there's some stress with it. First off, I love it because when it's multifamily, if you look at other investments, metals and stocks, people are using their discretionary income to invest in those investments. Well, for multifamily, they're using their income to live. They need that, right? So you can't not interact with real estate unless you live, on the streets. It's tangible. The cash flow, I mean, just the whole idea of getting the cash flow, the depreciation, so people that, and not just depreciation, but, you know, I'm sure you guys do like cost segregation too, where you can accelerate your depreciation. Whole goal is to get your income down to 0 or below, if I can. That's the goal, right? Legally. The terms, I mean, the loan terms right now for multifamily are best of the best. So that means something to me when lenders look at it and say, hey, I'm going to give you, you know, 80% leverage plus your soft cost and everything like that. There aren't many investments that you can even remotely come close to doing that with. So the leverage is really good. Equity capture, the appreciation, which I think has been really good, and you know, may not be quite as attractive in the next few years. I don't know that for sure, but at the end of the day, if you can ride through a storm, you're looking at things like what's your break-even occupancy, your break-even rents. You can keep the property. It will go up over time. It always has. You might have some dips, but the whole idea when you compare it to other investments, there's just nothing like it in my mind.
Mark, we had a golden nugget this weekend from our accountant. Maybe you can relate to this. He said to us, when I said, how do you qualify a CPA or an accountant? He said, ask them what their feelings are about tax avoidance and get their feelings about that. And I thought that was crucial because people are always afraid of the IRS. Avoidance is differently than fraud or negligence. What are your thoughts about that? I
would agree 100%. As long as you're doing everything legal, then push it, you know. And I would agree with his statements 100%. Also, you know, looking for CPA, you want someone that actually specializes or knows real estate. You know, there are other things with IRAs. People don't realize your IRA can be taxable.
Yep.
Well, a lot of CPAs, surprisingly, a lot of CPAs don't know that. Won't go into details, but the UBIT tax and UDFI and things like that. So you want somebody, not just a nice guy, but someone that knows what he's doing on the real estate side.
So you syndicate, and I'm sure you probably get a ton of private money from the self-directed IRAs. How do you handle that? Because we had a big discussion. He was our last speaker, and he was getting peppered and hammered by it. And my investors, my Jake and Gino community, I think we're looking at it from the wrong perspective. We're not going to use our money to invest put your money into a self-directed. We're going to get people's money from self-directed. And I know they're not going to get the depreciation right off and everything. But so how do you talk to your investors and say, listen, you can use a self-directed IRA, but there are some pitfalls?
Yeah, well, that's a good point. We do educate them. A lot of people just take in IRA money and don't tell the investors. They get their K-1 at the end of the year, and then they're like, holy cow, I got taxed on my IRA. I actually didn't get a distribution. I still got taxed because of the profits of the company, right? So educating them so they know, I don't think it's necessarily a bad thing. I've invested through my self-directed, you know, through a SEP IRA into other deals before. And so there's nothing wrong with doing it. He was getting peppered. Why was he getting peppered?
Because a lot of people, that's the thing. He not that he wasn't disclosing. I think people were like, well, why do I put my money in self-directed IRA to invest? And we're like, no, you're not putting your own money. You're going to be recruiting or raising money from other investors who have money in pension plans locked in. That was the I was trying to get them to get a mind shift. You're not going to use your own money. But how do you bridge that gap? How do you get that gap and say to them, listen, you might get taxed on the K-1. Are people still willing to give you money on their 401 or self, even if they know about the tax?
Very little issues with people, even after we explain it, because at the end of the day, the UBIT tax and stuff, UDFI is pretty low, so we haven't had much pushback at all.
Wow. And so where's the majority of the money you raised? Where is it coming from?
Well, from IRA, we probably have, I'm guessing, maybe 10 to 15% of our deals probably IRA. The rest just from pool of people that we've contacted and met over the last several years. We're still doing a lot of the 100,000 at a time, which is tough. We had a deal we had to raise 6.2 million on. It's a tough thing to do. But just from groups, going to meetups, meeting people. We have our own events as well. So we have, like you guys did, right? So it's a big thing to put on an event, as you know, I'm sure. Getting people there. And just going to different events and meeting people. People think they can sit back and it's all going to work out. You need to get out there into the game and meeting people. And people go to events and say, well, it's a time suck or whatever. Well, it is, but this is what you're doing. Or they go to an event and say, well, I've been to that event before and I'm not sure I'm going to really learn anything. I go to events where I probably don't really learn anything or don't learn much, but I'm there to also support the people that are putting the events on and or to meet people
Network.
that I can network with.
Yep.
It's critical.
So talk to me about that $6.2 million raise. I like to hear pain in the voice. What was frustrating about
Gina's
that?
up for blood today.
So we no, I love it, man. So we issued the PPM documents the Monday after Thanksgiving.
I hate that. It's between Thanksgiving and Christmas. Nothing gets done.
Always the crunch time.
I kid you not. And so that was the whatever date that was. It was actually a year ago. And then so Monday after Thanksgiving, I went on a cruise December 10th. That was planned. So it wasn't much of a cruise for me. I was raising money, and we had to raise it by end of January close. So yeah, it was tough. During the holiday time frame. We did it. We got it done. And end of the day, it's persistence. That's what's going to get it done.
So have you ever done a deal where you couldn't raise the capital?
No, not yet. Come close before.
So what would your contingency be if you didn't? I mean, Jake and I have never done this. That's why it's just, to me, I'm not gonna say it's foreign, and I'm sure we could raise it, but there's a lot of guys out there who are afraid. Maybe they have to do a little extra capital raising to do some capex or whatever, and they might come a little bit short. What would happen in that instance? You lose the deal?
You would, yeah. Now you could actually raise enough to close and continue to raise after the fact. Depending the way your PPM documents are structured, sometimes it can be up to 6 months after the fact. So, if you have acquisition fees and rehabbing the money that's not in the loan, theoretically you could raise some of that after the fact. But I would say, always having someone other than yourselves doing it and probably partnering with and having people on the sidelines that maybe could throw some cash in if need be. And then on your own, I've used line of credits before, my own line of credit before for, earnings and deposits and things like that. So having that, I think, as a syndicator is really a valuable thing to have. And you can throw in that cash if you need to close.
Mark, where did you learn the syndication process? I'm sure you didn't do it by yourself. You talk about mentors. Where can people learn about that process?
So we teach it, syndication, and then the real estate guys. I don't know if you know real estate guys, Robert and Russ.
Yep.
They do an event twice a year. It's not geared just around multifamily, just so you know, but it's geared around syndication. They do a great job on that. And then that's we have a 14-step process, and one of them is raising money. And we talk about all the legal aspects because that's the biggest game changer. You get involved taking other people's money, there are a lot of legal aspects that you have to be aware of before you start doing it.
So let me ask you, if you had to go back and you could have done it on your own, would you have done it on your own, or would you have used a syndication model?
I would have syndicated for sure, without a doubt, provided I had someone that actually was side by side with me.
And why is that?
Taking other people's money, man, it gets scary sometimes. People say I get nervous. I'm like, you should get nervous. I get nervous too every time I take someone's money, right? Because at the end of the day, something could happen and you could lose it. Big responsibility. But having someone that's been through it before and been through some war stories, I hear people say, I never want to invest with anybody that hasn't, everything's gone smoothly. I don't want to invest with you. So having someone side by side that's done it before and knows the legal aspects of raising money and things like that would be pretty imperative to me.
How's that deal going? The one that you just raised $6.2 million from last year?
That's the one we kicked our property manager out of. And it's that's just recent. Now it's occupancy. It's 100%. The two buildings, 100%, 90%. So occupancy is not bad at all. There's some other, more communication than anything. If you're not getting responses to your communication in a way that you think you should get it, and I have something to compare it against because I have other properties, then you need to take action. So the property itself, I mean, we've done pretty well with it, but it's more not getting, budgets, for example. Where are we at on budget for rehab? Oh, we're doing pretty good. Okay, well, where's the list? Keep sending me the draw requests. I'm like, this is useless. It tells me what you're asking the bank to pay, not what we have to do left. So those type of things. And we have a board. We had a board of directors, 5 board members at the time. SEC attorney from Harvard, Marcus Millichap guy, a CFO from a public traded company, and that gave us leverage to kick the guy out.
I want to touch on that real quick, because regardless if you have experience or you have multiple other deals, if your gut is telling you something is off here, I'm not getting the communication, but I don't know, is this right or is it wrong? Just move forward and get them out. Because if you listen to your gut on those ones, it's telling you, the right thing, and you don't need to have 10 other deals. If it doesn't feel right, you're not getting what you're asking for, something is wrong.
Great advice, without a doubt. And don't be Mr. Nice Guy. I tried that before; it doesn't work.
Well, what do they say? Kindness is mistaken for weakness. So you just, especially in business, you want to be fair, you want to be equitable. But at the end of the day, this is capitalism. If you can't perform, it's really time to get out, and you have a bigger, I guess, fiduciary responsibility, because you're taking money from investors. If Jake and I can't make money for cash flow for 1 month, we haven't syndicated. We're going to go to 800 something units, and we've been able to refi and repurpose our money. Right. I think that's why we haven't done it yet, because we're really uncomfortable and we haven't had to, let's say, but I think to get to the next level, to get to 2,000 units where we want to get to, I think we might have to start bringing some on. So I think you have an even greater responsibility, because like you said, you've got families and you've got people that are entrusting you with capital. So to people out there, it's scary, but
hey everybody, this is Russ from the Jake and Gino team. Unfortunately, we've had some technical problems with this particular interview. We thought what we had in the interview was worth sharing, and we're going to cut it short here. But thank you guys for listening, and we will see you next week.
We trust that you enjoy the Wheelbarrow Profits podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.